I think it is a puzzle that Americans haven't been saving much. We have traditionally been known as a relatively low saving country compared to, say, countries like Japan. But the dramatic thing is that from the early 1980s to just before the financial crisis, the savings rate went from basically 10% of our GDP down to 1% of our GDP. It was also a surprise because in all the decades before the 1980s, going back to World War II, savings had been constant in the United States. In fact, there were various theories and laws that the savings rate was a constant. Why did it go down so much? I think mainly because of the stock market boom and the rise in home prices. So Americans saw the value of their wealth go way up, and therefore they felt, let's spend a little bit of it. And an increase in consumption drove down the savings component. Then when the stock market crashed in 2008 and 2009, we would expect to see now that the savings rate would try to come back a little bit. I think a decline in national savings was expected to have three major consequences. First of all, a reduction in savings would normally mean we wouldn't have the funds available to finance capital formation here in the United States, and that's critical to our long-term economic growth. But in fact, in a global capital market, we just borrowed all the money in other countries, and it did not inhibit U.S. investment. Second, we worried, though, in the process of doing that, a low savings country borrowing everything abroad to finance its consumption would have to worry that foreigners would begin to question our ability to repay, and we would begin to see growing difficulties of that process. There was never much evidence prior to the financial crisis that that would occur, and in fact, foreigners rushed into the United States because of what they thought was our safe financial markets during the financial crisis. The one area where I do think it's very important is mainly in terms of American household savings to finance their retirement and the buildup of wealth prior to retirement. That, I think, was largely offset by the capital gains in the first part of the 2000 decade. That meant that they thought they were quite rich. That's now a problem because the crash of the housing market, the crash of the stock market, is bringing forward the fact that this wealth suddenly vanished on us. And we do now have a retirement problem for many Americans. American economists had predicted a crisis for the United States probably for over a decade, or a large percentage of us did. And it was normally based on the fact that we were borrowing so much abroad to finance our consumption. We couldn't continue this. So it was mostly predicated on a crisis of the foreign exchange markets. That's not what happened. We kept predicting it. It didn't happen, and the economy went on year after year. The crisis was the collapse here inside the United States in the financial markets themselves, particularly that centered around mortgages. So the crisis never came from when we expected it to, but the speed with which it happened wiped out a huge portion of American household wealth. And that is unlikely to come back. We expect home prices to stay down for some time. And while the stock markets come back to some degree, it still remains extremely volatile and unstable. There's two consequences of this. One is that households may be tempted to try to stay in the workforce longer, to try to make up the losses. I think many of us right now are engaged in trying to rebuild our balance sheets. The problem with that is that there aren't any jobs at the present time. So pushing in the opposite direction is a large number of people of retirement age are just giving up. And even though they don't think they have as much as they plan to have for retirement, they're beginning to take up Social Security and they're leaving the workforce. The second area where it's going to be a problem is this whole collapse has severely strained the federal government resources. And they just don't have the kind of money that we anticipated we would have to finance the public sector retirement programs. I think it is inevitable that both Medicare and Social Security are going to be scaled back to some degree. and the retirees are going to be thrown back more on their own resources, exactly at the time when their own resources have shrank to a large extent. I think the U.S. got into a lot of its current economic difficulties over the prior decade because of the excess emphasis on consumption, the reliance on foreign funds to finance that. That was always not a stable pattern. It is true that we could finance for a while the housing boom and other methods by capital inflows from other countries. But we don't want to ask people to do the same mistake that we made in the past. So pushing consumption as a solution to our problems runs the risk that we just revert to the same old pattern. And again, it will turn out to not be sustainable, and we begin to build in the next financial crisis. We need to, as a country, find a way to rebuild our productive base. Instead of emphasizing consumption, we want to emphasize investment and exporting to the rest of the world. We became quite unbalanced in our economic structure by so much emphasis on consumption.